Well, good afternoon and welcome to HYROX's weekly webinar where we are going to talk about what we see happening in the global economy and financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. Now, we invest our money in the exact same models as our clients, and we think that this is really important. We call it eating our own cooking. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HYROX, who, by the way, has done some wonderful bottom-up research for our tactical model and has been quite astute with a few of his value picks so far this year, continuing to add value to our models and portfolios while at the same time reducing our exposure to risk. I must also add that Paul has also been rather astute with some of his movements in our fixed income model as well. Our financial planner and wealth forecast specialist, Bianca Tomlinson, is also on the call. We'll have a question and answer period at the end of the call, so if anyone on the call has a question about any aspect of how we manage wealth, we invite you to feel free to ask questions. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we do each week, let's quickly recap our themes for 2016 before we get started on what has happened since we last talked. As you all know well by now, our overriding theme for 2016 is that financial markets will remain volatile, and we do expect that to continue. We think that the risk of a recession in the U.S. is high and is rising. Low inflation and deflationary pressures continue on a global scale despite the efforts of central banks to mitigate them, and that extraordinarily stimulative central bank monetary policy on its own has not succeeded in reigniting global economic growth, and now central banks are revisiting their options. The U.S. Federal Reserve wants to raise interest rates. We don't know that that will necessarily happen, but it seems the odds are in the favor of that happening for December. And there is also now talk of the European Central Bank beginning to taper its bond buying program. There has been a concerted pushback against globalization and freer trade on a global scale. Throw in the terrorist threat, Russia and Syria and North Korea, and the sum of it all is greater uncertainty. Well, bond markets are confused, and that means that all financial markets are confused. Equity market prices do not truly reflect the underlying fundamentals and are, in our opinion, expensive. And we are in a time when the risk-free rate of return is basically at zero. Some might argue it's negative. Inflation, depending on your circumstances, is at or about 2%. So the math suggests that to get better than inflation growth with your money, you need to take risk. Well, the question is how much and what kind of risk? We think that investors are taking on too much risk relative to their potential returns. Okay, let's look at what's been driving markets over the last week. Volatility has ticked back up, as we had suggested that it would, and we think there's more to come. With higher uncertainty comes more fear. Markets are somewhat neutral, but we could see this fear premium start to pick up in markets, and that would take the fear factor down back, we think, to previous extreme levels. Since our last webinar, our benchmark world equity index is lower by about 1% and up by about 4.25% on the year so far. China's Shanghai Composite Index was the best performer over the last week. The Swiss SMI Index was the worst performer. The Canadian TSX has been the best performing country index in the developed world this year, and China's Shanghai Composite has been the worst performing index. As I remind everybody each week, the broad and diversified benchmark equity index upon which we gauge the performance of our global equity model performance covers close to 2,500 companies domiciled in 23 developed countries and 23 developing countries, and covers 10 economic sectors. As a result, we watch closely how the key component countries' economies are evolving. However, it is also important to remember that many of these companies have a global perspective, so we also need to keep in mind that it is the companies that we are investing in, not necessarily the countries. Our benchmark equity index remains in its downtrend channel from back in May of 2015, and without follow-through buying to push it any higher. Year to date, the return is a little over 6%. The one-year return is just a little under 5%. The three-year return about 4.5%, and the five-year return is about 9.5%. And if you combine the equity and bond indices into a balanced scenario and allow for fees and any other MER costs, the total return for a 60% equity, 40% bond index combination year to date is 4.3%, about 3 3/4 for 1 year, and you can see how significantly lower that is from what we showed you on September the 30th. The 3-year return is about 3.70, over 5 years about 6%. In a 40% equity, 60% fixed income, so less risky portfolio, year to date about 3.80, the same almost for 1 year, 3.70 for 3 years, and just a little under 5% for 5 years. As we discussed last week, stocks and bonds have recently become positively correlated, and in other words, they are moving in the same direction. Well, this adds volatility to a balanced portfolio, which is usually expected to be offsetting and reducing volatility when they are negatively correlated. So when we look at a client portfolio, a client who started with us in January with a 60-40 balance, they have a total return this year to date after fees and costs of 6.7, almost 6 3/4%, or a little more than that. Nicely ahead of the benchmark, which is coming in at 4.32%. So interestingly, our defensive strategy has lower exposure than the benchmark to the equity market and has better returns. And now since September 30th, this portfolio is lower by about 0.3%, where the fully invested balanced benchmark 60-40 portfolio is lower by over 1%. Now that shows that our strategy is providing a better risk-adjusted return than the fully invested benchmark portfolio. The after fees and costs of a 1-year performance of a 60-40 HIROC client is 656 compared to the benchmark at 496. And looking at portfolio volatility, the client portfolio is lower by a little over 1% since September 30th, where the fully invested benchmark, as I showed you before, is lower by about 3.5%. Interesting, that statistic. The longer term 4+ year annualized total return since inception of 7.94, so just a little under 8%, versus the benchmark of a little under 6% over the same time period. Now, I also remind all of our listeners, as I do each week, historical returns are in no way a guarantee of future returns, although at HIROC we do work very hard to try to get the best possible risk-adjusted returns for our clients and ourselves at all times. Well, fixed income prices were lower, led by U.S. bond indices again this week. In the world of commodities, natural gas and oil were higher, gold was lower. Now, with a possible agreement for OPEC oil production coming in November, oil continued its uptrend from its February lows and rose back above the $50 level. Now, it does remain to be seen if, 1, OPEC will come to an agreement, and 2, if they actually will stick to that agreement. Remember, OPEC nations are historically notorious for overproducing despite agreed upon production cuts. Russia will likely be the wild card. Putin says he would agree to cut production, but recently they have been producing at their highest levels ever. So is there games afoot? We'll have to wait and see. The Bloomberg Commodity Index is also trending higher with oil and natural gas, of course. Well, the U.S. represents more than 20% of the global economy, and with over 50% of the companies in our benchmark index domiciled in the U.S., we keep a very close eye on what's happening there. The U.S. presidential election appears to be favoring Clinton with less than a month to go after all the recent drama. I will let the political experts make their predictions, but with Trump backed into a corner, who knows what might happen next. For investors, the big concern will likely be who gains control of the Senate and the House of Congress, which explains why the Republican Party appears to be distancing itself from Trump. It is thought that a Democratic sweep would see higher taxes for the wealthy and be a challenge to the financial and healthcare sectors, and likely not favorable for stock markets. Well, on September 21st, the Fed reduced their expectations for economic growth once again, and for 2016, as well as increased their expectations for unemployment. Last Friday, the U.S. employment data for September were released, which showed below average employment growth and rising unemployment to the 5% level. Now, on our recession watch, we again point out that when current employment levels converge with the 3-year moving average, historically a recession follows shortly thereafter. As the moving average continues to decline at a fairly swift pace, the increase in unemployment to 5% further narrows the gap and suggests that a recession may only be a few months away. We also note that the Fed's labor market index has slipped back below the zero level to a negative 2.2, and wonder if this will impact their decision to raise interest rates. At the moment, it is widely expected that the Fed will raise rates in December. This could, in fact, accelerate recession potential. Meanwhile, third quarter GDP estimates continue to decline, now down to 2.1% from expectations of a growth rate of 3.8% back in August. Elsewhere in the global economy, as we mentioned last week, the International Monetary Fund maintained its forecast for weak global growth and warned that further stagnation will fuel more populist sentiment against trade and immigration that could stifle activity, productivity, and innovation going forward. Meanwhile, there is a record-breaking level of debt. Again, according to the International Monetary Fund, global debt is at record highs and rising, said Vitar Gaspar, director of the fiscal affairs at the fund. Excessive private debt is a major headwind against the global recovery and a risk to financial stability, said Mr. Gaspar. The fiscal monitor shows that rapid increases in private debt often end up in financial crises. Financial recessions are longer and deeper than normal recessions. We have often brought up the global debt issue. We think that at the moment it is of major concern, although it doesn't appear to be on the headlines. Well, on the Brexit front, in a liquidity void in Asian trading last Friday, the pound dropped 6%. This spooked the currency markets and put Brexit and the UK's financial future back into the spotlight, and it continues. Well, according to the IMF, uncertainty following the Brexit referendum in June will take a toll on the confidence of investors. UK growth is expected to slow to 1.8% this year and to 1.1% in 2017, down from 2.2% last year. Well, in Canada, the labor force survey data released last Friday showed that employment rose by 67,000 in September, with most of the increase in part-time work. The unemployment rate was unchanged at 7% as more people participated in the labor market. Compared with 12 months earlier, employment rose by 139,000, with most of the gains, again, in part-time work. Over the same period, the total number of hours worked edged up by 0.2%. Well, where do we see all of this taking this? We normally would turn to the bond markets, which would normally lead other financial markets, but there has been some interesting developments in the bond markets. Bond markets have been falling steadily for the last few months as markets prepare for changes in central bank policy, whether it's the Fed raising rates, the European Central Bank slowing its quantitative easing, or the Bank of Japan redesigning its stimulus program. Bond markets are confused with an economic scenario that does not necessarily point to higher inflation, but central bank bond buying brought bond yields to levels that may have been overdone. It is not clear what this does imply for the future, but bond investors are not taking any chances, so the result is that bonds and stocks are trading in a more correlated fashion. In the U.S. bonds, yield curve was yields were higher, and the yield curve steepened slightly over the course of the last week. Higher yields and slightly steeper curve for Canada too, after that stronger than expected employment data. UK, steeper and higher yields. Same for the Euro-German curve. And negative yields have now moved to under 10 years, and the same for Japan. As for equity market value, we continue to stress the fundamentals for stocks do not look good. And this year alone, earnings growth for the year has been revised from an expected growth rate of 6% at the beginning of the year to a negative 0.1% at this particular time. Now, S&P 500 stock prices have risen by about 4.5% year to date. Now, that's off from higher levels of close to 6%, but we're starting to see earnings come back into the market as we enter earnings season. Third quarter earnings are expected to continue the negative growth for a 6th consecutive quarter. However, over the past 4 years, on average, actual earnings reported by S&P 500 companies have exceeded estimated earnings by 4.3%. During the same time, 68% of companies in the S&P 500 have reported actual earnings per share above the mean EPS estimates on average. As a result, from the end of the quarter through the end of the earnings season, the earnings growth rate has typically increased by 2.9 percentage points on average, and that is over the last 4 years. Due to the number and magnitude of upside earnings surprises, if this average increase is applied to the estimated earnings decline at the end of the third quarter, which we said was negative 2%, the actual earnings rate for the quarter would be a positive 0.9%. So basically, companies underestimate their earnings so that they can show better than expected earnings reports. However, if we saw what happened this morning with Alcoa, that certainly was a worse than expected situation, and I think it's had some psychological impact on the market, and one of the reasons why the equity markets were as lower today as they were. Well, why are earnings important? Well, we talk about this each week, but it is the fundamental reason for buying stocks. When investors buy stocks, they buy a stream of future earnings, which go to pay dividends or are reinvested in the company. The price to earnings ratio represents one metric that we measure stock prices relative to earnings by. The 10-year average price to earnings ratio is 14.3 times, and the 12-month forward price to earnings ratio, which incorporates analysts' forecasts for the future earnings, is currently at 16.7 times. That difference is what makes stocks expensive. We would prefer to buy equity assets when they represent reasonable value at or better than the long-term averages. Now, historically, and this is something we haven't looked at in a while, but when investors borrow to invest, the equity markets tend to follow them with buying, pushing up prices, and the opposite is true when investors sell to pay down their margin. So margin debt tends to lead, which means that S&P 500 is well ahead of itself relative to margin debt. Another metric that we're looking at that tells us that stock prices are expensive, and our view is that they're going to come down soon. What does it all mean? Well, again, and I repeat this every week, for over a year we've been taking a cautious and defensive posture to investing. That does not mean that we are not investing, but we are utilizing our skills to ensure that our client and our portfolios are invested to achieve the best possible risk-adjusted returns. It is clear that we have been able to not only capture growth, but keep it in times of higher volatility. That is truly very important, and to a large degree why we all sleep better at night. Part of the success of our year-to-date returns comes from what we've been able to achieve in our tactical model, but also some movement in our fixed income model. And Paul, do you have anything to tell us this week?
Not a ton this week, Scott. We added late last week a very small position in a gold mining company. Gold's had a huge sell-off, so I'm looking to add a couple of those in a small way. And away from that, we continue with our strategy. Two things for the overall portfolios. Number one, in tactical, we continue with some energy exposure, both through some selective stocks and their underlying high-yield bonds, which I think are a much less volatile way to play them. And just overall, as you mentioned, until this correlation breaks down between government bonds and stocks, we're not going to be adding any government debt or any interest rate exposure through investment-grade bonds into the portfolios until we see that either one of two things has to happen. Well, I think in order. I think interest rates, government bonds need to move higher, rates move higher, and if the market does sell off at that point, that being the stock market, then we might see the correlation break down where there's more of a benefit to the flight to safety or flight to quality of government bonds. So that's all I have to add for this week.
Thank you for that. And just as a reminder to our clients that we remain tactically in the global equity model as well. We remain with underweight positions in equity and a higher weight in more defensive cash positions. All right. What's coming up? Well, we've got some data coming from China on Wednesday and Thursday, and then some U.S. retail sales data on Friday for the month of September. Give us an update on what the consumer is thinking in the U.S. And then next week we're going to see some inflation data from on Tuesday from the U.K. and the U.S. And then some unemployment data from the U.K. on Wednesday, as well as the Bank of Canada's latest interest rate decision. We'll get a little bit of an insight into the latest GDP growth in China. And then on Thursday, we're going to see the European Central Bank's interest rate decision, followed on Friday by inflation data from Canada. Well, that's it for today's discussion. If there are any questions and anybody listening would like to ask them, please go ahead. All right, no questions this week, but if anybody is listening to this version as a recorded version and have questions, certainly please feel free to email them to us. We do appreciate all the feedback that we get on these calls, and as always, we certainly thank you for taking the time out of your busy schedule to tune in. Don't forget to tune back next week, but until then, this is Scott Tomlinson signing off.